Hello class, welcome to week 2 of Accounting 350, Intermediate Accounting 1. I wanted to compliment you on the discussion. So we had a pretty lively discussion. For individuals, you'll see how we did in the discussion when I grade your comments based on the rubric that's posted on Blackboard. But for the class as a whole, I think it was a good discussion. I'm going to warn you about a couple of things, or advise you about a couple of things. One is that when there's a question that asks your opinion, we don't really just want your opinion. We want your opinion based on what you've read and learned from the materials in that chapter or from earlier materials. So always an informed opinion based on what you've read. And that will now apply to chapter 2 as well. Now, chapter 2, the problem is much more in depth. It will require a bit more thinking and analyzing. And hopefully, since I know some of you are going to give wrong answers, that you'll actually disagree with each other politely and talk back and forth about why you think your answer is right and some other answer is wrong, and come to some consensus. Okay, and that is for the discussion. Now, in chapter 2, you're going to read about the conceptual framework of accounting. This is the basic theory of what we do and why we do it. And it would be good if you would read that in detail and come to understand it, watch all those online videos. I want to advise you about several things that are going to be important for you. And the whole chapter is important for you getting ready for the quiz, the exam, but there's a few concepts that are important for you through your whole accounting education. And first of all, you have those 4 principles. You have the measurement principle, which tells you we measure things at historical cost, the original transaction price, except when we don't. And generally when we don't, it's because we've decided to use fair value. So we're reporting things at historical cost, or if not at fair value. And you'll learn in later chapters why fair value is important. Okay, and then secondly, we have the revenue recognition principle. And this is super important. This tells us when we can recognize, and the word recognize means we record actually in the accounts and can report it. So when can we report the revenue? When can we recognize it? We recognize it when it's met 2 criteria. First of all, it has to be earned. Earning just means you've done all the work that entitles you to the revenues. And two, that it has to be either realized or realizable. And realized means converted from whatever it was, say inventory, into cash or a claim on cash. So if you're at Sunmart and you're buying cornflakes, it's inventory until they run over the scanner and put it in your bag, and now you pay for it. Okay, so they've converted that from inventory now to either your cash or a claim on the credit card company for that same amount of cash. That's realized, or it could be realized or realizable. Okay, so these are the important parts of revenue recognition. It's going to be earned, and it has to be either realized or realizable before you can record this revenue. And then there'll be some more detailed rules you'll find in the chapter. Later on, chapter 18, the whole chapter deals with revenue recognition to get some either finer details. Okay, and then you've got what they're calling now the expense recognition principle. We used to call it the matching principle. And we call it the matching principle because for most expenses, you're going to match the expense with the revenue. Okay, so if you report the revenue, then you're going to report the expense that helped contribute to earning that revenue. A simple explanation would be for something like inventory. Okay, so all the work to generate the inventory, and you record that as inventory. But now, when does that inventory become a revenue? It becomes revenue when it's sold. Okay, so if you can record the sale, then you'll also record the cost of goods sold. And when you record the cost of goods sold, that removes the cost of the inventory from the account. So you record sales, record cost of goods sold. They go together. If you can't record the sale yet, then you don't record the cost of goods sold yet. Okay, so you're matching them. I guess the reason we don't call it match principle anymore is because all costs are not matched. There's some costs that either by tradition or because of practical reasons, we don't match them. For example, we don't match most administrative costs. We don't try to match the benefits of paying the CEO's salary with the periods that might be benefited by that CEO's decisions. We just don't do it. In practical, we don't do advertising. We don't try to match advertising to the period benefited because it's unrealistic. Some advertisements might benefit the firm for decades. Some advertisements might be awful, might be a detriment. So we don't try to match them. A third one would be research and development costs. Just generally we expense them as incurred, and we'll learn the detail of that later in chapter 12. But just generally we expense them as incurred, not because we can't really get a match, but because firms have in the past manipulated that number. They have decided to record it as an asset and match it to future periods, even when they knew that the research and development they'd been pursuing wouldn't really result in a saleable product. So we match when it's practical and traditional to do so, and otherwise we record the expenses as they're incurred. And finally, the full disclosure principle, that we disclose everything a reasonable user needs to know to interpret the numbers on the financial statements. We disclose all of it, either in the financial statements themselves or in the footnotes. Okay, and those you're just going to need to know forever. You apply them all the time. Questions come up, and rather than refer to a rule, because a rule might not exist, we can refer right back to these principles. Well, are we going to record the revenue? Well, I mean, report it. I mean, has it been earned? And if so, has it been realized? Okay. So these are things you'll just need to know. A couple other concepts will come back over and over again is this idea of materiality. Is the item big enough to make a difference in a decision? Now, another book talks about other things, but primarily, is it big enough? And that affects us several ways. First of all, we don't want to report immaterial things. So if you've got, $1 million of cash and $10,000 of investments, you don't want to report $1 million of cash, $10,000 of investment. $10,000 is immaterial. It's too little to make a difference. You just include it in the cash. So we don't report immaterial numbers, immaterial details. Secondly, if the GAAP rules specify a certain procedure, but the underlying numbers that you're dealing with aren't material, then you don't really have to follow the detailed GAAP rules. Thirdly, when you're auditing, then you might find errors, and if those errors are immaterial, then you don't force a change. So these are sort of implications of materiality, and you're going to need to remember it and understand it now and forever if you're going to become an accountant. And then the last item that I thought we probably ought to discuss would be going concern. And going concern is of ongoing importance because in almost every audit we have to make some kind of judgment as to whether the company will be a going concern into the future, or if there's some elevated risk that it won't be. And that's because all of our accounting rules assume a going concern and therefore have meaning. But if you remove the going concern assumption, many of them don't have meaning. For example, we record things at their cost, say a building, and then depreciate over its useful life of 30 years. And that's meaningful because it's that old cost allocation of matching the cost of the building with all the years in which it's being used to generate revenues. But if you're not going to be an ongoing concern, then the cost is of no relevance, and the allocation of cost is of no relevance. The only thing that's relevant is how much you're going to get for the building when you sell it off. Okay. And so since so much of what we do depends on that assumption that the company is going to be ongoing, if there's some danger the company can't be ongoing, then that has to be disclosed. And so that's something that's going to come up for you off and on, again, forever. Anyway, those are just some pointers. I hope you enjoyed the reading, the videos, do well on the quiz. Next week, we're going to be doing some review, but at least get into some numbers. Bye-bye.